41 years ago, Congress passed the first law subjecting Social Security payments to taxation. And based on the rules at the time, only about 10% of recipients were impacted. Today, more than half of all recipients pay some tax on their benefit, generating almost $50 billion a year in revenue. It's time we talk about it. How is Social Security taxed? And why are so many more people paying taxes now than before? During tax reform of the 1980s, Congress established thresholds and decided if you earn a certain amount of income over those thresholds, your benefit would be taxed. These thresholds refer to something called combined income, a term that is purely applied to Social Security taxation and one that many people don't understand. Your combined income consists of a lot. Your earnings, your investment income, withdrawals from retirement accounts like an IRA or a 401k, pension income, tax-free income, etc. And then you add half of your Social Security benefit to get your combined income. The thresholds are different for those who are single and those who are married filing jointly. To keep it simple, I'm only going to focus on those married filing jointly thresholds. If your combined income is less than $32,000, no portion of your Social Security is taxable. If your combined income is greater than $32,000 and less than $44,000, then up to half of your benefit is taxable. If your combined income is greater than $44,000, then up to 85% of the benefit is taxable. These thresholds are not to be confused with tax rates. They simply determine what amount of your Social Security benefit is taxable. The actual tax rate is based on your personal ordinary income tax rate and will differ for everyone. Here's the interesting part. Despite regular cost of living increases to Social Security benefits, these thresholds have never changed. Aside from adding the third threshold in 1993, the test has been the same for more than 40 years, which is why the number of people now paying taxes on their Social Security benefits is much greater. It's also why, even with substantial cost of living increases, it feels like your check isn't stretching as far. The average Social Security benefit for a married couple is roughly $44,000 a year. Using the combined income calculation, that means essentially if you have any other income greater than $20,000, you are over the top threshold and up to 85% of your benefit can be taxable. I know that alone sounds complicated, but believe it or not, there are actually 3 different tests or formulas you can use when applying those thresholds, and you can choose the lower of the 3. But that math is better handled by somebody with an accounting software. As I mentioned, the actual taxes you pay will depend on your personal ordinary income tax rate, a percentage determined by your total income. As you can see, there really isn't an easy answer for financial planners to provide when somebody says, how much will I pay in taxes on my Social Security? But for now, it's safe to assume that you will likely pay at least some tax, and you can choose to have those taxes withheld from your Social Security paycheck. This does not answer the very common question of how much can I earn while on Social Security? That is the earnings test, and I'll talk you through that in next week's video. That's it for this week. This is Jeannie, the 401k lady.